Forget $100. Why today's silver price means miners go berserk. They told everyone to watch one number. They said when silver hits $100, then everything changes. But what if that number no longer matters? What if the real signal already appeared, quietly, unnoticed? Because today, silver did something unusual. It did not explode higher, did not collapse either. Yet mining stocks began to move as if a line had already been crossed. This is how major shifts begin, not with headlines, but with small signals most people ignore. In moments like these, markets do not shout, they whisper, and those who fail to listen understand too late, because by the time everyone agrees, the opportunity is gone, and the risk has already arrived. Welcome back to the currency game. They speak to the audience calmly, like talking to someone who has lived long enough to see currencies change, prices rise, and promises quietly break. If someone has seen inflation before, if experience has taught them to be careful with money, then subscribing is not about trends. It is about staying aware. So they ask gently, if this kind of thinking still matters to you, if you believe understanding money is more important than chasing excitement, then subscribe. And one more question. From where in the world are you watching today? They begin with a simple observation. Most people believe silver has a single price, but in reality, silver has many prices, and none of them tell the full story. The number shown on a screen is only a reference point. It is not a measure of scarcity. It is not a measure of stress. And it is not a measure of future supply. For years, investors were trained to wait for targets. $50, $75, $100. These numbers became mental anchors. They created patience, but also blindness. While attention stayed fixed on targets, deeper changes continued quietly underneath. The modern silver market is not driven by physical exchange. It is driven by contracts, paper promises traded in volumes far greater than the metal itself. This creates an illusion of abundance, an illusion of control, and most dangerously, an illusion of stability. When prices remain calm, people assume balance, but balance does not mean health. Silver today is priced inside a system designed for liquidity, not truth. Futures markets reward speed. They reward leverage. They punish patience. This allows silver to appear stable, even as strain builds below the surface. Mining companies understand this difference clearly. They do not sell contracts. They extract metal from the ground. They face rising energy costs, rising labor costs, declining ore quality, and increasing regulatory pressure. When silver prices remain flat, miners do not feel safe. They feel squeezed. Margins tighten. Exploration slows. New projects are delayed. This does not create immediate shortages. It creates future shortages. Markets are poor at pricing future consequences. This is where the illusion becomes dangerous. Because when the gap between price and reality grows too wide, it does not close slowly, it closes suddenly. This is why focusing on price targets misses the point. Markets under strain do not move step by step. They reprice in bursts. Mining stocks respond earlier because they live in physical reality. They cannot operate on promises. They react not to where silver is, but to whether the current price can support future production. When that math stops working, behavior changes. Mining equities are not predicting excitement. They are signaling pressure. They are responding to a future where today's silver price no longer makes sense. This is the real warning. Not that silver is cheap, but that the system is pretending nothing is wrong. Miners see the cost structure clearly. They see a future where supply cannot expand at current prices. And when supply becomes uncertain, markets do not adjust politely. They adjust violently. Those waiting for confirmation from headlines will find it only after the adjustment is complete. This is how the illusion ends. They do not begin this part by looking at charts. They begin by looking at strain. Because markets rarely break where people are watching. They break where pressure has been ignored for too long. On the surface, the silver market appears functional. Trades clear, prices update. Liquidity seems available, but systems under stress often look calm right before failure. The first pressure point is supply. Silver is not running out, but easy silver already has. Most of the high-quality deposits were discovered decades ago. What remains is deeper, lower grade, and more expensive to extract. This changes everything. Each new ounce requires more energy, more labor, more capital, and more time. Yet the market price does not reflect these rising inputs. This creates a silent squeeze. Mining companies cannot stop producing overnight, but they also cannot expand freely. When margins shrink, exploration budgets are cut first. New projects are delayed. Risk-taking disappears. This does not affect supply immediately. It affects supply later. And markets are poor at pricing delayed consequences. The second pressure point is demand. Silver is not only a monetary metal, it is an industrial one. Energy systems depend on it. Electronics depend on it. Defense systems depend on it. Unlike investment demand, industrial demand does not wait for price dips. Factories do not pause because silver feels expensive. They secure supply because production schedules require certainty. This creates a conflict. Paper markets assume flexibility. Physical demand requires commitment. When both exist in the same system, tension builds. The third pressure point is leverage. Modern commodity markets are built on borrowed confidence. Traders use margin to amplify returns. This works when prices rise steadily. It fails when volatility appears. When exchanges raise margin requirements, the effect is immediate. Positions must be reduced. Collateral must be added. Many cannot comply. They sell not because they changed their view, but because they lost their option to stay. This creates forced selling. Forced selling looks like panic, but it is mechanical. The market does not care why someone sells. It only reacts to volume. This is how sharp drops occur without fundamental change. And this is where confusion spreads. Observers see falling prices and assume weakening demand. But often, demand remains unchanged. Only leverage is being removed. This distinction matters. Because once leverage is cleared, the market stands exposed to reality again. The fourth pressure point is capital access. Mining is capital intensive. It depends on financing cycles. When metals are ignored, capital becomes scarce. Share prices fall. Raising money becomes expensive. This forces miners into survival mode. They hedge less, they invest less, they produce less aggressively. This reduces future supply even further. The market rarely prices this correctly. Instead, it waits for a shortage to appear visibly. By then, adjustment is violent. The final pressure point is trust. Silver pricing depends on confidence in settlement. Confidence that contracts represent metal. Confidence that delivery is possible when demanded. As long as most participants roll contracts rather than demand delivery, the system holds. But confidence systems do not fail gradually. They fail when behavior changes. When too many participants ask for certainty instead of exposure, the system tightens. This is why stable prices during high stress are dangerous. They encourage complacency. They signal control where fragility exists. Miners respond earlier because they cannot rely on abstractions. They operate in physical reality. They see energy costs before traders do. They feel labor pressure before investors notice. They experience permitting delays long before headlines appear. When mining equities begin to behave erratically, it is not speculation, it is response. They are reacting to a system where future supply does not align with current pricing. This is why pressure matters more than price. Pressure accumulates quietly, then releases suddenly. Silver does not need a dramatic story to move. It only needs the system to reach its limit. And when that happens, repricing is not optional. It is forced. This is the part most people miss. They wait for confirmation. They wait for clean narratives. They wait for numbers to make sense. But markets under pressure do not explain themselves. They act. And those who understand pressure position before the explanation arrives. They begin this part by challenging a common belief. Most people assume mining stocks simply follow the price of silver. If silver rises, miners rise more. If silver falls, miners fall harder. This belief feels logical, but it is incomplete. Mining equities are not mirrors of silver. They are sensors. They react not to where silver is, but to whether the current price can sustain the system that produces it. This is the key difference most investors miss. A silver bar does not have expenses. A mining company does. Every mining operation carries fixed costs: energy, labor, maintenance, permits, debt. These costs do not move smoothly, they jump. When silver prices rise slightly, revenue improves. But when prices cross certain thresholds, profitability changes dramatically. This creates what is known as operational leverage. Small changes in metal price can produce large changes in earnings. But the opposite is also true. When prices fall below viability, damage accelerates quickly. This is why mining equities move ahead of the metal. They are pricing survivability, not sentiment. Equity investors do not wait for shortages to appear. They estimate whether future production is possible under current conditions. When that math begins to fail, stocks move immediately. Another reason miners move early is valuation compression. During long periods of neglect, mining companies trade at depressed multiples. Assets are priced as if the future barely exists. This creates instability. When capital begins to reassess risk, revaluation happens fast. There's little resistance because prices were already compressed. This explains why mining rallies feel sudden and extreme. They are not sudden, they are delayed. Years of neglect unwind in weeks. Mining equities also reflect access to capital. When metal prices are weak or uncertain, financing dries up, exploration stops, development slows. But when confidence returns, even slightly, capital re-enters aggressively. This capital does not go to silver bars. It goes to companies that can expand output. The equity market moves first because it is forward-looking. It prices what might happen, not what already has. Another overlooked factor is scarcity of quality assets. There are fewer viable mining companies than most investors assume. Many projects are marginal. Some exist only because capital was cheap in the past. As costs rise, the number of economically viable mines shrinks. This concentrates capital into fewer names. When demand for exposure increases, prices move sharply. This is why miners appear to behave irrationally. They are not reacting to headlines. They are reacting to narrowing options. There is also the role of short positioning. Mining equities are often heavily shorted during periods of pessimism. This creates vulnerability. When conditions shift, shorts must exit quickly. This adds fuel to upward moves. These rallies are mechanical, not emotional. They are driven by positioning, not optimism. Silver itself does not experience this effect. It does not have short squeezes in the same way equities do. This further explains the disconnect. Another critical point is time. Mining decisions operate on long timelines. Permits take years. Mines take years to build. When prices signal scarcity, response cannot be immediate. This makes the system brittle. Equities price this brittleness early. They reflect the risk that future supply cannot respond fast enough. This is why waiting for silver to confirm often leads to late entry. By the time silver prices move clearly, mining equities may already be repriced. This creates frustration for observers. They see miners rise and assume speculation. They wait for pullbacks that never come, but the move already accounted for future conditions. This is not enthusiasm, it is anticipation. Mining equities act like warning lights. They flash before the engine fails. They are noisy because they must be. Those who understand this do not chase price. They study feasibility. They ask a different question. Not, where is silver going? But can the current price support future production? When the answer becomes uncertain, miners move, and they move fast. This is why their behavior should not be ignored. It should be examined. Because when equities move ahead of the commodity, it signals imbalance. And imbalance never resolves quietly. They begin the final part by widening the lens. Because silver and mining equities do not move in isolation, they react to pressures that exist far beyond the metals market. Capital always moves with intention. And when it moves early, it reveals stress before it becomes visible. In stable systems, capital favors efficiency. It seeks predictable returns. It rewards scale, leverage, and financial engineering. But when confidence weakens, capital behavior changes. It becomes selective. It becomes defensive. It searches for asymmetry. This is where silver and mining equities re-enter the picture. They do not attract capital during periods of optimism. They attract it when trust in monetary stability begins to erode. This erosion rarely starts with panic. It begins with subtle inconsistencies. Rising debt without corresponding growth, persistent inflation explained as temporary, currency dilution framed as policy. Over time, these explanations lose credibility. When that happens, capital does not announce its departure. It reallocates quietly. It moves away from promises toward constraints. Silver represents constraint. It cannot be printed. It cannot be expanded by policy. Mining equities represent constrained production. They cannot scale instantly. They are limited by geology, energy, and time. This is why they behave differently during late cycle conditions. When capital senses that future purchasing power is uncertain, it looks for assets with built-in resistance, not because those assets are perfect, but because alternatives rely too heavily on trust. Another critical factor is timing. Capital does not wait for consensus. It moves when risk-reward asymmetry appears. By the time headlines shift, allocation decisions are already made. This is why silver prices may appear subdued while mining equities begin to reprice. The metal reflects current transactions. Equities reflect future expectations. This divergence is not a malfunction. It is information. It suggests that some participants no longer believe current pricing reflects future conditions. This belief does not require collapse, only imbalance. The system can function while becoming unstable. That is the most dangerous phase. During this phase, volatility increases without explanation. Narratives conflict. Signals contradict. Observers become confused. They search for single causes. They demand clean explanations. But complex systems do not provide clarity on demand. They reveal stress through behavior. Mining equities behave aggressively when capital senses fragility. Not fragility in silver alone, but fragility in pricing mechanisms, cost structures, and monetary credibility. This is why the story is not about commodities. It is about confidence. When confidence in currency weakens, capital seeks anchors. Historically, these anchors are not chosen emotionally. They are chosen structurally. Assets with limited supply. Assets tied to real production. Assets outside direct policy control. Silver fits this category imperfectly. Mining equities fit it asymmetrically. They offer exposure to scarcity without requiring direct ownership of metal. They also offer leverage to repricing events. This makes them volatile. But volatility is not the same as risk. Unrecognized risk is far more dangerous. The true risk lies in assuming stability where adjustment is pending. This is why today's silver price matters, not because it signals opportunity, but because it signals delay. The longer price ignores pressure, the sharper the eventual response. Markets do not drift back into balance. They snap. This snapping rarely benefits those who waited for confirmation. By the time confirmation appears, repricing has already transferred advantage. This is why experienced capital watches behavior, not commentary. It studies where capital flows ahead of narratives. It notices when mining equities attract attention without explanation. It recognizes that these movements often precede broader reallocation. This does not guarantee outcomes, it signals probabilities. And probabilities matter more than predictions. The final lesson is simple. Silver is not issuing a promise, it is reflecting strain. Mining equities are not celebrating, they are adjusting. Together, they form a signal that the current system is functioning. But no longer comfortably. Those who understand this do not panic, they prepare, they do not chase price, they evaluate exposure, they do not wait for headlines, they watch behavior. Because when capital moves before explanation, it is not guessing, it is responding. And by the time the story becomes obvious, the window for strategic positioning has already narrowed. This is how late cycle signals appear, quietly, indirectly, and only once.